All right, everyone, welcome to another episode of the show. Today we have John S. Pennington Jr., who was the co-founder of a family of private equity funds that by the time of his retirement grew to well over $28 billion in assets under management. During his tenure, he served on the board of directors, held signing authority on over 1,200 bank accounts as the deputy chief financial officer, and was the president of over 100 corporations. In 2021, he retired with the company after they went public on the New York Stock Exchange, and is still a substantial shareholder as a partner with partner emeritus status. So with that, welcome in, John.
Thank you, Chase. I'm glad to be here. Yeah.
Excited to have you. Mentioned beforehand, we golfed over the summer, got to know you a little bit. And had the idea to have you on the podcast with your background. I know you're going to share a great story here. So again, excited to have you.
Thank you. Hopefully we can give your listeners what they're looking for.
Oh yeah, absolutely. Well, first question I typically ask is just to talk a little bit about your upbringing, kind of give us some context about, childhood, early years, parents, any influences.
Yeah, I had great parents. That's an advantage I had over some people in this country. Two great loving parents, and born in Tennessee, raised in Las Vegas, Nevada. And when I was younger, I just knew I'd always have to be an entrepreneur. I'd always have to work for myself. I had to be in the driver's seat of my car rather than the passenger seat. It just was me. And but I was a poor student, and I remember when I was about 17 years old, 18, you're getting out of high school, you're thinking about careers. I looked in the mirror, and this is what motivated me for the next 40 years. I looked in the mirror and I said, John, you're not afraid of being poor. And you're not afraid of being, I got it wrong. I'm not afraid of being poor, and I'm not afraid of being old. I'm just afraid of being old and poor at the same time. And I've repeated that to myself, every month or whatever when I'm driving around for years and years and years. And that is what really drove me to kept me motivated to start businesses and watch them succeed, and start another one, watch it fail, watch it succeed. And so I've started 14 businesses in my lifetime.
Wow. 3
I've made a lot of money on, 3 I lost money on. And the rest in the middle, they all kind of made some money, and they're all kind of okay, right? But the things I told my kids as they grew up is 3 things. 1, 2, 3. It's academic to me. Stay healthy, wake up every day and try, and eventually you will succeed in the United States of America. So number 1, stay healthy. Number 2, get up every day and try. And number 3, you will eventually succeed in the United States of America, because I believe the United States is the best country in the world for entrepreneurs. It is the most fertile soil with capital and people and the way they think. And if you're an entrepreneur and you were born in Nigeria or you're born in Thailand and you move here and you're an entrepreneur, that's your lottery ticket. If you were born here, that's your lottery ticket. That's the day you win the lottery, right? Because for entrepreneurs, I believe it's the best country in the world. And so, listen, I have friends who are unhealthy and they're vastly successful. I'm just saying mine is academic. 1 + 2 = 3. Stay healthy, wake up every day and try, and eventually you succeed in the United States of America. And I had companies where I was going to bed crying on my big pillow because I didn't know how to meet payroll by Friday, and you had to figure out a way. But if you woke up the next day and just tried, you eventually succeeded as an entrepreneur. Now, some of those companies didn't succeed, but my goal was that I was going to be a successful entrepreneur. That was the goal. So that's kind of how it happened. Yeah.
I love it. And I think the perseverance that you mentioned is so critical. I mean, never just waking up consistently, even if there's, stress, meeting payroll, things fail. It's getting back up and trying again. And even in our 1.5 years of our company's existence, I've seen that it just takes that mindset and that grit to continue to overcome some of those challenges.
Look, most battles in life are won by attrition. You look at a lot of war battles, attrition, right? You look at some divorce cases, attrition. You look at, successful people, attrition. They just outlast the other competitors, right? Mm-hmm. And then they're on top. Yeah. So a lot of battles in life are attrition.
Yeah. So you're 18, 19, you're thinking about what you want to do. I read you went to spent some time at BYU and then University of Utah. So tell us, was it before college? Was it during college? When did you decide to start kind of your first business and go into the
Well, no, I was looking for businesses. I would go to these, weekend, franchise things all the time, thinking just learning. But I always knew one day I'd be, so I was at BYU for a couple of years, then transferred to University of Utah, graduated there in economics, and started my first job with a charity, and I was raising capital for that charity. And then soon after that, started my first business and was off from there.
Yeah.
So yeah, I knew it was inevitable, and I found one and I just took off with it. Right.
Yeah.
And so, and then 40 something years later, IPO on New York Stock Exchange.
Right.
So, yeah.
Right. So what was that first business, John, that you started?
Okay, this is an interesting story. So, and we'll get into the dollar in a minute, but since President Nixon took us off the gold standard with the US dollar in 1971, came on television on, I think it was August 15th, 1971. He said, hey, listen, the dollar's no longer backed by gold. Okay. About every 10 years from then, there's something like boom happens in the country, right? Boom. Right. So in 1978, sometimes I gotta get my notes here on dates. I get messed up on the dates here. So, So that was 1971. So just go a little bit longer. 78. You have the stock market crash. And then in 88, 89, you have the Soviet Union falls. And so that was that was the first ones. The next one was the dot-com bubble. The next one was the Great Recession in 2008. So it was, 98, 99, 2009, and then 2020-ish is the virus, right?
Right.
Is the COVID. So it's about every 10 years, everything goes boom. So we had a boom, and the planet changed when the Soviet Union wall dropped. The Cold War was over. So what happened was kids in Eastern Bloc countries, Eastern Europe, they could not get American products up until 88, 89. And so my partners and I, we had some inkling that we could exploit that. And we lived in the Western United States. The Western United States is the place where Levi button fly 501 denim jeans was invented. Mr. Levi Strauss in San Francisco, right? And so if you watch all the old American films and people going on Johnny Carson at night or Jay Leno, the Tonight Show, they're all wearing these faded Levi jeans. And the kids in Eastern Bloc countries saw this Hollywood stuff, but they couldn't get the product. So from 1989 until about I'm getting the dates wrong. 1988-ish, 89 till 1998, about a 9-10 year run, me and my partners in general, just to condense it, me and my partners, we collected used Levi 501 jeans from all over the Western United States, the 13 Western states. We shipped them to our warehouse. We'd sew them, repair them, scrub them, re-dye them, whatever we had to do, and ship them to Eastern Bloc countries or in Eastern Europe to sell. One of my partners, both of them eventually moved to Southern Germany, and they were the marketing over all of Eastern Europe. And I was the supply on this side, and we collected and had seamstresses and people scrubbing and washing and dyeing and shipping, and it was fantastic. It was the U.S. dollar was king, and the dollar was low for a long time. President Reagan kept it low, and that increases exports. And it was a 9-year run, and so for 9 years, that's all I did. Tried to find Levi's. Use Levi's and repair them enough to sell, and then ship them to my partners, and they would sell them in Eastern Bloc. That's what we did.
Yeah,
it was crazy.
It's amazing.
It was a huge business. It was not some little one table kind of thing. We did a lot of business. It was fantastic. Yeah.
Yeah, I mean, if you were doing it for almost a decade, it must have been going really well.
It was going fantastic. Yeah.
What was the name of that venture? What did you guys call it?
Well, we had several names. In Germany, they call it a GmbH. A GmbH, it's a G with a small uppercase G with a small M, B and an H. GmbH. In Spain, we had a company. It was called SL. But we had it. The main word was Recycleware USA. That was our main thing, and we would go all over the Western United States, purchasing used Levi's from the public and thrift stores and wherever. And then we would leave a town. We would try to contact every pawn shop and every consignment store. And we left that town after, weeks and weeks and weeks of marketing and buying jeans ourselves from the public. We would hopefully set up 16, 17 locations, pawn shops and consignment stores in this town that would buy jeans on a consistent basis. We ended up eventually having, I think, about 650 locations across the United States, or Western United States, buying jeans from the public and shipping it to us. Plus we were buying large amounts of jeans, holy jeans from thrift stores, and they were shipping them to us. So it was it was a big operation.
Yeah.
It was really fun. Really fun. Yeah.
So how did that end up winding down?
Things just stopped. I mean, we knew, look, fashion stops, right? Fashion changes. These are tight jeans. 501s are a tight fit jean. And in 97, 98, the baggy look came in.
Mm-hmm.
Okay. The first Gulf War was kind of over, and kids were now like, well, the United States had missed its goal. After the wall fell, the United States was like king of the world, right? Everyone loved us, right? They wanted anything with USA on it. And so for a few years after that, then the first Gulf War, people in Europe were like, the US is bombing people in Kuwait, Okay. Yeah. And then the third thing happened. So the baggy look came in, so the 501s, and the dollar started to go strong. The dollar was kept low for a long time. When the dollar's low, you can sell things overseas. When the dollar's high, you can buy things from overseas. Imports are great. And those three things all happened in 97, 98. It's a trifecta, and that just kind of killed the whole thing. The customer in Eastern Germany could not afford the price increase when the dollar increased. They just couldn't afford the exchange.
Makes sense.
So it crushed the whole thing.
Kind of a natural transition out, yeah. So okay, so then what was next for you after that point? You're done.
So now I'm wiggling, trying to find the next gig, and I start a few businesses, and they don't work, and I do this. And in 1999, I saw this reporter. I can't remember a news station. They were doing a report on hedge fund managers out of New York, and they said hedge fund managers pay really, really low taxes, and they make a ton of money. And they were vilifying these on this news. And I was like, wait, I want to be one of those guys, right? I don't want to, how do I pay really, really low tax, like make a lot of money? So I decided I'm going to be a hedge fund manager. And if you would have known me back then, you would have just, so I didn't tell anyone because they're just going to laugh at me. I didn't tell my friends, I didn't tell anybody, but I got my Series 7 stockbroker's license, passed that test. I got my brokerage license for mortgages, started understanding how sell mortgages for a while just to learn how to do it. And then I got my Series 65 license. So it took me 5 years, and I read private placement memorandums, limited partnership agreements over and over and over. And I taught myself how to start your own fund. And in 2004, me and one other person, we came together and we launched our first fund, which was, we brought in investors' money into a limited partnership. They were called limited partners. And we were the general partner, which is the fund manager. And we brought in money and we did short-term real estate loans, 1 to 6 months. And what happens, it wasn't just real estate. It was, there were business loans backed by assets. It was an asset-based lending. So you might have a guy who's making widgets for Walmart, and Walmart has a big order, and he's going to miss payroll next Friday. Mm-hmm. And he needs, I don't know, $200,000 to make payroll. And then we say, well, we'll loan it to you for, what do you need? We need a 60-day loan, 90-day loan until the invoice gets paid from Walmart. We ship all this product, they get paid us, they'll pay us. So we would do these short-term loans, but we needed a piece of real estate in first position, deed of trust, in the capital stack. We needed, first position to do a loan. So he would have some property. We would loan him $200,000, take a first position on that property. And 60 days later, whenever term was, he would get the money in from Walmart and pay us back.
Got it.
And for a business owner, that's what you have to do to keep your business afloat sometimes. Or some builder, and builders do this all the time. They have enough money to build 10 homes, but they don't. They build 13. Mm-hmm. And they get to a point where they don't have enough money to meet their payroll or whatever, and they need so they'll give us a first position lien on something, and we would loan them money for 120 days or 180 days, something like that. And so that was our first two funds. And then in 2008, we changed. We stopped lending because the banks were all frozen. And so if you lent money to someone, like on real estate, they couldn't pay you back because the bank couldn't take them out because there was no banks lending. So our third fund that we launched in late 2008, we started purchasing real estate. We'd go to banks and try to buy something that was foreclosed upon, and the bank really, really wanted to sell. And in 2009 and 10, they really wanted to sell stuff, and they sold them really cheap. And that just took us off. And then in 2021, public on New York Stock Exchange, and that was it.
Yeah.
But there's a lot of detail in between that and that, right?
Yeah.
But you look back and I remember the second fund we had in lending. Mm-hmm. It was called Bridge Loan Capital Fund 1, Bridge Loan Capital Fund 2. And we had our second fund. We had a first fund doing great, and we launched second fund. And then late 2007, 8 hit, and we were like, man. And I had some competitors that were competing against us, and they just left the business, and they went and did something else. I don't know what they went. They went and did something else, but we dug in and just switched, and we started, rather than lend, we started to purchase property. And I can honestly tell you, if 2008 and 9 would have never come around, I would still be lending.
Sure.
We were making great money, but the big, huge money forced us into purchasing property, and that took us down another path, down that way. So, and then we had, a lot of, we got a lot of talent to join us. Me and my original partner, we look at each other all the time, and we'd say, look, you and I, we both know we're not smart enough to buy 1,200 unit apartment complexes. We know how to buy 20 unit apartment complexes, but not 1,200 units. Yeah. So we went out and sought talent, people that had been doing a certain job for 20 years in their industry, working for somebody else, and tried to get them to come and be a partner. And we did. We were successful in recruiting people way smarter than us. So when I say, I have brilliant partners, I have brilliant partners with a capital B. I mean, it's astonishing. And so when you put together a team of incredibly brilliant people, investor money just kind of flows. It's still hard to raise capital. No, it's hard to raise capital, but it's way easier when you have a team of guys or girls or mix, whatever you got a great team, and they're experts in all what they do. The money is easier to raise.
Yeah. Well, so many lessons there, John. I think one being, like you said, hiring around yourself. I think some of the best entrepreneurs, maybe they're not the smartest person in the room, but they know how to hire and they know how to execute and build teams.
Put a team together. Yeah.
That's great. Yeah. I'm curious, what kind of rates were you guys lending out at that, just to kind of compare to today? Yeah.
The market rate back in 2004, and this is market. My competitors were charging the same thing. We would charge 6 points to put a loan together, the underwriting, to go out and see it, to hurry up, and then 16% interest.
Okay.
And so, every once in a while people would say, now I know the rates are lower now because interest rates have gone, they went down to 0 for a while, which we'll talk about in a minute. But at that time, 2003, 4, really 4 and 5, 6, right in there, that was the going rate. And we basically said, listen, I realize you're getting, the 6 points seems expensive to you, but wait, when you sold your house the house you live in, to another person, you paid a real estate agent 6 points. And they drove out around in a pink Cadillac. This lady drove in a pink Cadillac. She had pink hair, and she didn't even own anything. She just put a sign up and started calling people, and then sold, right? We have accumulated a bunch of money, put it in an account. It's sitting ready for it to go, waiting, making really low interest rates, in money market account, waiting for you to knock on my door and say, I need $200,000 by next Friday. So you want my team to run around really fast, run down 3-4 hours away, or fly in a plane to your property, underwrite your property, get back, put it through committee, and get the money all there by next Friday at 5. You need all this. That's the going rate. It's going to take us 6 points to get that all together. And that's just how we did it.
Yeah. And so for those who are unfamiliar with the fund structure, you mentioned 6 points or 6% on the what you're putting out or lending. How did you get paid? I mean, apart from the 6%, was there a carried interest?
Good question.
Fees?
Yeah. So on our first 2 funds, we didn't want to get licensed because we just wanted to get going. So we didn't charge a management fee to our investors. It was a total performance fee basis. So the loan, we do a 90-day loan, let's say, and the 16% interest rate and 6 points. We would throw the 6 points and the whatever interest rate we got from 60 days, 30 days, 180 days, whatever. We'd throw all that money in a pot, and then we would decide under the APY, annual percentage yield, what that APY ended up with. And the 6 points really popped it, right?
Sure.
Popped it high. So we had a waterfall calculation. And so we were an American waterfall. Every deal we got paid on. It wasn't a European waterfall. So every deal we got paid on. And so if and there was a preferential rate of return, and I believe back then the preferential rate of return was 12% APY. So if the loan if the loan produced 11% APY, me and my partners, we made 0. But once it got above 12, we started sharing in the APY. And once it got above 16, once the investor made 16% APY, me and my partners kept the whatever is above. So it made 25 or 32% APY. We kept above. on those first two funds. And then later, when we started buying property, it was an 8%, IRR. Every property had to hit an IRR of 8%, then over 8.1%, then we would start sharing. But APY was calculated that, and that's how we got paid.
Yeah.
And some loans sometimes for some reason didn't hit and we made nothing on it. But our pitch to our investor was, look, you're not charging a management fee. And every single loan, you make the first, big chunk. Mm-hmm. And so we're reducing your risk so low that if we get a really big one, like a 34% APY, well, we gain it. We get to keep it. And so that was the trade-off for the investor.
Yeah, and I think that's important as a first-time fund manager, giving some of those more preferential terms, 12% pref, no management fee. I mean, to get dollars in the door, and just kind of
that's what we did. We were unknown at the time in our city and state, and to get people to talk about us, we needed to have something different, no management fee, and a high preferential rate of return, which we call the pref. What does your investors, what's their pref? And that's kind of the term.
Yeah, so that's great. Well, the other point you made is pivoting. So you went from lending to acquiring with the shift in the market.
Because the market made us.
Yeah,
right.
Yeah.
And it was great. It was great.
It's great. So I did want to talk about, you mentioned apartments. So you go from lending on, asset-backed businesses to buying apartments. So what was the thesis? Why go down that strategy? Why do apartments?
Well, the market dictated it. It was like every bank in the United States was foreclosing on apartments. And banks can foreclose on a few assets a year, but 30 or 40 or 50 or 60 assets, they can't handle it. And they need to move it off their books. And so basically, you got to understand real economics of, think about this. I'll just hypothetically think about there's this little bank in southern Arizona, okay? And they have a president, two vice presidents, and they have like $500 cash in the bank, okay? And the FDIC is coming to see them on, May 1st to go to the audit. And they're like, guys, if they come in and see we only have $500 in the bank, cash, they're going to shut us down. We're way below our reserves. Okay, what can we sell? Well, we had a loan on a big, huge apartment complex that we had to take back. We lent, let's say the bank lent $22 million, okay? And they're like, but if we had $10 million in the bank by May 1st, the FDIC is going to be mad at us, but they're not going to shut us down. So we kind of knew this was going on because the bank president's trying to save his job. The vice presidents are trying to save their job because they want to go home to their wife and say, honey, we don't have to move from our house. We can still meet our BMW payment. So they sell us a property that they lent $22 million on. The guy probably paid $27 million on. Let's say he put $5 million cash down. He borrowed $22 million. He's owned it for a few years. And now 2009 has hit and things are just going crazy. And he can't make payments. So he's decided not to make payments. And so it goes, month. And then finally the bank says, we have to foreclose. They foreclose and they have it in their, it's an asset on their, on their asset balance sheet. And so we offer them, we'll put $10 million in your account by, May 1st. And they say, great. If you send it on April 30th, we'll accept it. We'll sell you. If you send it on May 1st, deal's off. So we wire them $10 million and acquire this asset. Of course, the asset's run down, of course, right? But there's a lot of money we have to put into it. But the build cost on this thing was $17 million, the replacement cost. And so this was 2009. And so we just kept doing this because we knew the little bank president or the medium bank president or whatever was trying to save their job. So the FDIC comes in on May 1st. They do their books. They go, wow, you guys have $10 million in the bank. But you did this bad loan. Yeah, that's right. They slap them on the hand, but the bank stays open, right? And their sister bank down the street got shut down because they didn't do this, right? And so that was kind of really that took us off. There was a lot of money to be made by buying really, really low and waiting a few years, fixing the property up and selling in 2013 or 14 or 15 kind of thing.
Yeah, makes sense.
Yeah.
And you mentioned your partner on the lending side. Who was that? Who was your original partner on the bridge loan fund?
Yeah, I don't want to get into names.
Okay. That's fine.
But anyway, I ended up with 32 partners.
Yeah, that was my question.
It was just me and a guy, and we had 6, and then we had 13, then we eventually had 32 partners, and we're managing $28 billion asset under management, and we're at the end we've got limited partnerships that do multifamily, We're doing limited partnerships that lend on multifamily. We're doing limited partnerships that buy office buildings, limited partnerships that buy senior assisted living. We just in all the kind of boring real estate. We didn't do high-end hotels and stuff like that. We're just doing the blue collar, office buildings, blue collar. We just kept doing that, and that was kind of our mantra that whole time.
Makes sense.
So, yeah.
And what was your role for those first, 2008, 2009, those first 3-4 years?
I had 15. Look, I'm not a great money raiser. I'm a good one. I'm not great. So I always knew I needed a great one because we're going to go. So we ended up, the first guy that I had partnered with, he was a great money raiser. And then other partners joined the firm that were incredible. And so what we found was that in capital raising, there's really 3 different personalities. There's a personality and a training, someone that can go after institutional money. And there's a person that can talk to family offices. And there's another person who can talk to high net worths. And so we actually I had 3 partners that just kind of, or more partners than that, but they focused on their areas of expertise and they kind of divided it up because they had really the guy that can raise money from high net worths can't really raise a lot of money from institutions. They don't talk the same language. And the guy that really can raise a lot of money from institutions, he's good, but he's not really great at high net worths. And so we divide that up, and that's just to really go out and chunk out after capital all over the world. That's kind of how we broke it up with my partners. Yeah.
Makes sense. And what advice would you have, John, when you bring on partners? Because it sounds like it was originally you and your partner, you guys have this idea.
Yeah.
How did you think about sharing equity, sharing, ownership?
Well, that's why funds are so cool, because the general partnership is like the president of the fund. And the general partnership is where, you really chop that up. That's where all the carried interest, all that low taxed money comes. And so we, as we brought in partners, we just used that pie and sliced it up. And we just knew that pie grew. We would be happy taking a less pie.
Yeah.
And so, look, this is reality. If me and my original partner would have never brought in other partners, we'd probably today be managing, I don't know, $200 million, $500 million, right? And the company today is $48 billion, which I'm still a big shareholder of, right? And $48 billion, if you have a small slice of that, well, and so, I'm just saying we were good, but with my partners that we brought in and joined the firm later, we're great. I mean, it's really fun to be around a lot of great people and watch them execute day after day in greatness. It's inspiring. It's really inspiring. Yeah.
I love that. And I've heard that over and over again. It's better to have a small piece of a watermelon than a big piece of an apple. You know what I mean?
Yeah.
So that's great. So, I mean, you mentioned it. You guys obviously scaled into an insanely large company and fund. Yeah. From a raising capital side, we kind of touched on a little bit, but what was the strategy there? I mean, how did you get into raising, $10 million for a deal to raising billions for a fund vehicle? I mean, it was
really 2008 and 2009 because we switched to, listen, you're watching the TV and you're watching, let's say, I don't know, Blackstone or BlackRock, it says on TV, they just bought a portfolio from Bank of America, $200 million portfolio they bought from Bank of America for, $50 million. Well, the normal Joe or Jane out there can't do that. And we said to these people, listen, you guys see this on TV. We're doing this. We can do it as a group. If a bunch of people put their money into our limited partnership, we have the clout to go to the Bank of America and offer, we'll buy this portfolio. And that's kind of how we did it. We went, you had to scale. And all of my 14 businesses in the past that I'd run, it's like I always had this. I got them to a certain size and they wouldn't scale. That's the hardest thing I think for entrepreneurs is to scale their business. But when I went to the fund model in 2004, it was the easiest thing to scale I've ever seen. It just was naturally made to scale. And so that's how we did it. We just told people we're going after the big ones, which had the bigger margins. Like listen, when you go to the courthouse steps and you bid on a foreclosure on a fourplex, there's 100 people there bidding against you. When you go to a bank and bidding on a 1,200 unit apartment complex that are 600 units vacant, There's only one other bidder.
Yeah.
And if one of you get it, the margins are huge, right? It's not like you're making the margins are huge. So we just kept telling people, you want big margins? Then we're the guys to do it. So that's kind of how we went after it. So
makes sense. And within the real estate and private equity space, you do see the syndication route where there's a single deal, they're raising around that versus the fund route where you have commingled assets, you're diversifying. What would you say, and what have you seen the pros and cons versus a single deal and a fund? Yeah,
so we we went to the fund model because we missed on a syndication deal. What syndication deal is for the listeners is you have a property and you have like 6 investors and they're all wiring their money in on a certain date. One's wiring 1 million, one's wiring 2 million, one's wiring 750,000. You have 6 of these people wiring money into a title company and you're going to close on this deal and this loan. And we had one guy that couldn't get his money in on time. Something happened and he was going to be a day or 2 late and the wire didn't come in. So all 5 other people wired their money in. All the docs were ready. We're ready with the borrower. We're ready to lend, and we're going to sign it over to him, the loan. And one wire didn't come in and he had a deadline and he missed it. And so I was mad. I was really mad. And so I just said to my partner, we're going scuba diving. So we got in a plane and we flew to Ecuador, went on a scuba diving trip. And on the way back, and this is 2004-ish, right? Almost 4. And the way back, we got stuck in Miami. We had a 14-hour layover. The flights got mangled up. So we went to a resort all day and we sat there by the pool. And I once again laid out the whole, I've been planning this fund since 1999. It's now 2004. It's 5 years. And my partner says, let's do it. Why don't we start our own fund? And so it took us about 6, 7, 8 months after that to actually launch the fund. And we launched our first fund in 2004. Without that, without failure, we never would have, we'd still probably doing syndication deals today, right? Maybe. And so, but once you go into the fund model, I'm the check writer. I'm not waiting for people to wire money in. I have the money in the bank. When I say to somebody, I can meet that by next Friday, I can. And so that's the difference between, that's one big difference between syndication, and which is a great model to get started. But eventually, if you're doing lots of syndications, you want to go to a fund model because it's takes so much time to raise money for each individual deal. You get a deal, you have to go out to investors, pitch it, raise the money, close the deal. You get another deal, pitch. So you spend a lot of time raising money when you should be spending, you're an expert or you have a team of experts that can get great deals. You should be spending 95% of your time finding the greatest deal, underwriting the greatest deals, and 5% raising money. And that's what a fund, when a fund's really working right, that's what a fund really is able to do. And so therefore, your success rate goes way higher and you can do a lot, larger volume, meaning you can scale. And that's what a fund does. It scales.
Yeah, such great advice. Did any of your investors have a hard time with that transition?
Yes. We lost a few, but we had most of them came. Most of them came with us. Yeah. But you're going to lose a few investors going from syndication. You're definitely going to. But you're going to be in this pie over here, and then over here, one day you're going to be in this huge pie over here because you went fund model.
Yeah, that's great. And you touched on a little bit, John. But as you went from apartments, how did you guys, over that 10, 15 year run, start to diversify? And I mean, now when you look at the company, you mentioned opportunity zone, you've got office, you've got these different industrial. Yeah. I mean, how did that transition, or how did you decide to diversify and go away from kind of one niche?
It was really, you identify different verticals that you can go after, and then you have to identify, can I find a team of people who can run that vertical? So when you run let's just hypothetically say you're going to run a vertical on single family homes, which we never really did a lot of, right? But you need someone that's been doing single family homes, a team, not just one person. You need some girls and some guys and gals. They've got a little bit of gray hair. They've been doing it 15 years. It's not like they've been doing it 3 years, and they've worked together for 3 to 5 to 7 years. So they know how to argue. After they argue, they still stay together. They still perform, and they had a good track record. Then once you've said, I want to go into the single family home, vertical, then you got to find the team, and that team is hard, and that team has to culturally fit your team, and that's how it happens. And we went after some verticals that we could not find the right team, but we knew we wanted to be in that vertical, but you couldn't find the right team. And then we found verticals where we found the great team, great partners, brilliant partners with a little bit of gray hair in their head. And they had been around that industry, not just real estate, that particular vertical for 15 or so years. And that their culture, their work ethic, they fit with us, we fit with them. And that was the team. So after you go after that vertical, then you have to fill in the personnel. And that's the hardest thing.
Right.
Finding that team.
And how did you, because I've read Steve Schwartzman's book, Blackstone, they did a very similar thing. Like, hey, we're starting off doing these smaller deals and then they want to do real estate. So they brought experts in. Yeah. But how did you incentivize if, maybe you were bolting on an existing company or existing team or poaching, executives?
Yeah.
How did you get them to come over and give up kind of maybe their own entrepreneurial ventures to join?
Let me answer that question. Then you want to go to Steve Schwartzman for a minute. Okay.
Yeah, sure.
Okay. The first question is, okay, so I know how to start businesses. I just have it. I've done it all my life. You have to think this way. I want to become large. I want to become a large company. All right. I assume there's a guy or a lady. They went to an Ivy League school. They've been working on Wall Street for 15 years. They're one of the top investment bankers ever, right? And you know what they think about every day when they drive to work? They work for somebody. They work for JP Morgan. They work for somebody. They think about one day, I'm going to be my own hedge fund manager. But they don't hedge fund manager. They don't know how to do it. They've been employed. You have a person working over at, let's say, a big, huge bank, and they've been doing underwriting 17-story apartment complexes in New York for 17 years. They've been doing loans. That guy or that lady drives to work every day. One day, I'm going to start my own real estate fund. That person is there, and they just don't know how to start. They can run the company better than I can once it's started. So I already had it started. And so I just knew I knew they were there. I just had to keep looking for them. And once I found one, listen, you're going to come over here. You're not going to make as much money for the first 2 years that you're making now. It's not a salary. You are an owner now. You have a vesting schedule, of course. You're an owner of this fund. But you do the math. If it works, if you can really do what you say you can do, we're going to make way more money. And guess what? Listen, when you're 65 years old, you know what you're going to think? And if you never try to start, you're going to think, I should have tried to start I should have tried to be an entrepreneur one time in my life. Are you going to work for this bank for 40 years and retire? Or are you going to be the one person who says, I'm going to try? Now we might fail, but at least you're going to be 65, 70 years old, retired, saying, I took a shot in my life. And this is kind of the same pitch. You got to take the shot. And I'm telling you, this is your best shot. It's 2009, 10, 11. We're doing real estate. You can buy cheap. We're going to make a lot of money. You should quit your bank job that you've had for 15 years and use some of that gray hair and that knowledge. Come over here, be an owner, and let's see what we can do. And that's the target you go after. Now, I want to switch to Steve Schwartzman's book. Okay. Everyone knows Steve Jobs. Apple founder, right? Everyone knows Steve Schwartzman, right? Okay, so they both took their companies public two different ways. Steve Jobs took his public company in an Inc., an incorporation. And every year, what happens in an Inc., the shareholders get together and they vote on who runs the company. They vote you, right? In a general partnership, limited partnership scenario, the limited partners who are the investors, they never get to vote who's the general partner. And so in 1999, when I learned this, in 99, I thought, wait a minute, I can have billions of dollars in my fund with a bunch of investors, and I'm the president of this. And if I don't commit fraud, which I'm not going to do, then they can never vote me out? Right. That's what Steve Schwartzman did. In that structure, he took his company public. Under that same structure, Steve Jobs took his company public under an Inc. Steve Jobs was eventually voted out of the company he founded. Steve Schwartzman can never be voted out of the company because he's in a different structure. Yeah. And when I learned this in 1999, I thought, that's for me. I'm going general partner, limited partnership structure, fund structure, because if it ever gets really, really, really big, I don't want the billionaire that's invested into me saying, you know what, John, we don't want you running the company anymore. I want my son running the company. Yeah. And we're going to vote you out. We're going to put my son in as president. Thanks for all your years of hard work. See you later. I didn't want that to happen. And those are the two Steves, Steve Schwartzman and Steve Jobs. Same thing, going public under two structures, and that's the structure I took out. Now, Steve Schwartzman didn't go public back then, but I understood the structure back in 1999. And when I learned about it, it was like a epiphany. I just knew that that's where I had to go.
Yeah,
So
such great advice. I love it. Love it. And speaking of going public, and whatever you can or can't share, but I'm curious about that process. And I mean, for you personally, having, been very critical to the birth of the company and all of that, like how was that experience going public? And
it was fantastic.
What was that decision like?
I was actually gonna retire about 6 months before.
Okay.
And then my partner said, we're going public. I said, we're going public? Well, I'm staying on because I want to go to New York and, watch the floor and just watch everyone ring the bell and stuff.
Yeah.
So anyway, we'd found my replacement. And then a few months later we went public and I was still on payroll and was able to travel out with my partners. It is look, listen, when you walk out of business school, when you're a kid, you're in college and you get your graduation. I had an economics degree, or you have a business or finance degree. Your dream is one day I might be a part of a company that goes public on the New York Stock Exchange, not the NASDAQ, not the pink sheets, not the bulletin board, the New York Stock Exchange, the granddaddy of them all. And when that week was just, I can't explain it. I don't have a lot of words to explain the feeling of being a part of a company with great, incredible partners, all working together as a synergistic team to make something fantastic happen. And since, like I said, since we went public, we were managing 28 billion. Now we manage 48 billion. So once you are public on the New York Stock Exchange, there's a lot of more hurdles you have to go. You have to have audits every quarter and every year. And so because there's more scrutiny on you, more people have confidence in you and they invest more money with you. So if someone's going to invest $1 with you before you went public, they'll invest $5 with you after you go public, big institutions. And so it helps the investor be more confident that the things that are running in a company are great. Now, you've seen a lot of companies go bankrupt on New York Stock Exchange. I'm not saying it can't happen, but the probability is low because the New York Stock Exchange has a high barrier of entry for teams. So it was fantastic.
Yeah. And apart from investor confidence, were there other critical reasons why the firm decided, hey, we're going to go public? Was it liquidity for the partnership?
Yeah. You don't really, that's not a great reason to go public. Hey, we want to go public so the partners can cash out.
Yeah.
That's not a really great reason. And that wasn't our reason. The reason we needed more capital. We had our business model could scale even more if we had more capital. And that's why you go to the capital markets. That's what NASDAQ, that's what IPOs are about. That's what SPACs are about. You're trying to raise more capital because your model could grow even faster if it had just more capital. And so that's the real reason you go after capital. If you don't need more capital, then you keep it tight. You keep it home. You don't, that's the real reason you should go after capital, is because your model's working so well and it can scale. That's it. Yeah,
makes sense. Yeah. Well, shifting a little bit to what we have here on the table, you're an author of 2 books.
3 books.
3 books.
Yeah,
okay.
but this is my first business book.
Okay.
Dollars, Gold, and Bitcoin: The Fed's Hidden Agenda and How to Profit from It, by John S. Pennington Jr. That's me. And my son, John Pennington VI, and my other son, Bridger Pennington. So both boys contributed to the book, but it's mainly my book that I put together and had them contribute some stories in there and make it really good. So.
Yeah, love it. And prior to that, Big Bang Theory versus the Bible.
Yeah.
Right.
Yeah.
And then what was the third book?
The first book years ago, I wrote Mr. Mormon.
Okay, Mr. Mormon. Okay, great. Well, tell us a little bit about this book here.
So,
John.
Dollars, Gold, and Bitcoin. Okay, here's the you want a good conspiracy theory?
Love it.
Okay, here's a great conspiracy theory. Here we go. Okay, so listen, Americans, they love pancakes. They have an insatiable desire to eat pancakes. I don't know why, but you go down to a pancake house on Saturday morning, you have to wait 30 minutes for pancakes. Okay. So when people say it's selling like hotcakes, it's selling really good. Now, they should stop saying that. Start saying it's selling like greenbacks, because there's a product that's far better, sells faster. It's called the US dollar. It's the #1 product that mankind has ever invented. It's better than iPhones. It's better than cars. It sells, you make trillions of them off the conveyor belt, and people like me and you will work 80 hours a week to get more. Other people will lie, cheat, and steal to get them. And then another trillion is made off the conveyor belt, and people will work 80 hours a week to get them, or they'll lie, steal, and cheat to get them. It's the best selling product ever. Now, I realize that the dollar, as you print more, the value of the dollar goes down. I get it, okay? But we're going to talk about compared to what. So that's the premise of the book. Now, the premise of the book really is, though, the Federal Reserve. The Federal Reserve's number one job, and I realize they have a job of keeping unemployment down. They have a job of keeping inflation under control. That's ancillary jobs. Their really true job is to protect and promote their number one product, US dollar. And they do it as a team. The Federal Reserve, the SEC, the IRS, the President of the United States, the US Navy. Their number one job, as long as everyone around the world is accepting and using the US dollar, everything else works, right? Mm-hmm. If that breaks down, everything doesn't work, right? And therefore, gold could be a competitor. Bitcoin could be a competitor to the US dollar. The Chinese yuan could be a competitor to the US dollar, right? And therefore, you see things in the news that you're just like, that doesn't make any sense. But when you put that premise in there, they're protecting and promoting their number one product. It kind of makes sense, which we'll talk about in a few minutes. But so let me give your audience just a few things. Okay, so 2013-14, well, sorry, let's go back. 1907, there's a big stock market crash in the United States. 1907. 2013-14, the Federal Reserve is created. 2029, there's a big stock market crash, okay? And 1933-34, there's the SEC comes out. The SEC is created and comes out with the act, right? But a lot of people don't know is in 1933, after the crash, in the United States, it was illegal to own gold. You could get thrown in jail for having 5 gold coins in your pocket. Now, a lot of people don't know that. This happened from 1933 to a little after 1971 when we took off the gold standard. And this is what happened. In May 1933, President of the United States, executive order, you must, if you have gold bars, or now you can have a gold watch or a gold necklace. I'm not saying that. But you had to sell your gold to the U.S. Treasury, the Federal Reserve, and they would give you cash money for it. And it was all over and it was patriotic. Think about 1929. We had the back crash, the Great Depression's in, and they're saying, listen, to shore up our country, we need to put all the gold in Fort Knox and have it backed by the U.S. dollar, and that will get our country out of this Great Depression. And so it was patriotic to sell, everyone. If you're not doing it, you're not a real American. Mm-hmm. So it was all patriotic. Okay. So, so this went on and until the end of, and so we were the last ones into World War II. And so prior to us getting in, we're selling grain and guns and tanks to everyone for gold. And so by the end of the war, 1944, the war's we knew we were going to win the war by 1944. The reason, our country was producing 50,000 airplanes a year. That's 1,000 airplanes a week we're pumping out. Germany's making like 2,000 airplanes a year, right? Mm-hmm. We're making I can't remember the numbers, 20,000 machine guns a year. They're making 4,000 machine guns. It was a numbers game at that point. But the point is, in 1944, 44 countries sent 1,000 people to a place called Bretton Woods, New Hampshire. And it's called the Bretton Woods Agreement. And at that point, now this is a crazy statistic, the United States owned 66% of all the gold bullion in the world we had. So they reset all the currencies around the world in 1944 at Bretton Woods. And they basically said, listen, the US dollar is backed by gold, but the French franc is no longer backed by gold. The French franc is going to be backed by the US dollar, which is backed by gold. Okay, that's kind of why we went. 1944 started. So by 1971, France was like, you guys are printing way more money than you have gold. You guys are abusing the system. We know it. So this is what happened. If your grandfather or my grandfather in 1945 or 1955, if they could not take their dollar and go get gold, but if you were a French citizen, you could transfer your US dollar into gold, but US citizens could not. It was against the law for US citizens to own. So President de Gaulle of France sent his 2 ships over to one of our harbors to pick up his gold. He had all this cash money. He says, we're going to pick our gold up because these guys are printing way too much money. So he brings it over, ready to get the gold. With big ships, 2 ships, and President Nixon on August 15, 1971 says, "Oh, we decided that you people around the world that are trying to manipulate our dollar, we decided that temporarily we're not going to back the dollar by gold anymore." And the next Monday morning, it was over. Fiat currency was there. So the US dollar became, the US dollar is 53 years old now, right? In fiat currency. So President de Gaulle had to send his ships back with all the cash in back to France because he couldn't get his gold. And so then in 1971, the dollar really changed to petrodollar. From the Bretton Woods Agreement in 1944, it didn't say this exactly, but it was kind of like this. If the US dollar is backing everyone else's currency around the world, then what we're going to do is, I got one interlude here. After the war, everyone's navy was gone. Spain's navy's gone. Italy's navy's gone. Germany's navy's gone. Russia, everybody. The US had their navy intact. Japan's navy's gone. China's navy, everyone's navy, they're gone. Britain had pretty good navy. We had a lot of navy. And we basically said, this is kind of, I don't want to say it says this in the agreement, but this is how it happened. If you trade your oil, if you buy and sell oil in US dollars only, you don't need a navy anymore. We'll protect your shipping lanes. And so in Saudi Arabia, they signed an agreement with Saudi Arabia, you don't need a navy. Any ship that you ship out of your ports, we'll protect it for you. Just make sure it's all in US dollars. That creates insatiable demand for the US dollar. Okay, that's one reason. Another way you create insatiable demand for the US dollar is you tax all your citizens in US dollars. So me and you, this year, we have to get US dollars to pay our taxes. We can't pay in chickens. We can't pay in Bitcoin. That creates insatiable demand. In the last few years, if you flood the earth with low interest rate loans in US dollars, people have to pay it back in US dollars for 30 years. So you're creating insatiable demand for 30 years. So right now, most oil transactions around the world are in US dollars. So if you like, let's say 1972, you're in Germany, you want to buy a tanker of oil from Saudi Arabia. You can't send your German Deutschmarks down to Saudi Arabia. No. You send your German Deutschmarks through the SWIFT system, which is a dollar-based system, US dollar-based system, to the Fed, New York Fed. And the New York Fed then transfers them from US Deutschmarks into US dollars and then wires them to Saudi Arabia. And then Saudi Arabia ships you the oil. That's how it happens. Mm-hmm. That creates insatiable demand for their number one product, right? Our number one product, the US dollar. So this goes on and on and on for years and years and years. And then President Nixon, obviously, we're going to fiat dollar, and they just started printing money. And so since then, same things happened. A little country anywhere in the world now has the ability to sell their goods and services across the world without having to have a navy. And so as long as they kind of just do the US dollar kind of thing. And that has created the world reserve currency. Now listen, in 1960, the US dollar was 45% of all US currencies, US world reserves. In 2000, it was 71% of all US, current. No, sorry. I think 1960 was 45%. In 2000, it was 71%, and now today it's still 58%. World reserve currency, 58% is US dollar. 20% is the euro. So sure. The Chinese yuan today is 2.7%. 40 years ago, the Chinese yuan was 0.02%. And the Chinese have had the fastest growing economy ever on the face of the planet. Ever. No one's ever had a faster growing economy than them. And they went from 0.02 to 2.7% of world currency. So world reserve currency. So are you telling me that if they keep growing for 30 more years, they're going to be 7%?
Right.
Right? It's going to be, people say the dollar's going down, and sure, it's going down, but it's still 58%. Right? And it's going to be really, really tough to knock it off. I give this example. People say to me all the time, Bitcoin's going to take it. I love Bitcoin. I think Bitcoin's the greatest idea I've ever heard of. The problem with Bitcoin, it has no navy. It doesn't have military, right? Yeah. There's no one forcing you to take this stuff, right? The Bitcoin has a lot of great things for it, but there's the things it doesn't have, right? And so the U.S. Navy around the world, pushing the agenda of U.S. dollar is the number one issue of the American. Now, look, the U.S. dollar might be the greatest Ponzi scheme ever. I agree with you, right? But guess what? Very large Ponzi schemes, there is no mathematical way to taper a very large Ponzi scheme. It doesn't exist. Therefore, the only way to play it out is just to keep playing it. And therefore, most of my wealth is in US dollars. I'm pro US dollar. I'm not pro yuan. If I was the president of China, well, then I would be pro yuan. If I was the president of Russia, I'd be pro ruble. So back to the oil. So we know of two people that we know of that tried to trade large amounts of oil in non-US dollars. Muammar Gaddafi of Libya and Saddam Hussein of Iraq. Within years of them doing those transactions, both of them died. And I'm not saying the U.S. killed them. What I'm saying is the U.S. backed away from them and let other people go after them. All right. And so then the latest guy we know is Putin.
Yep.
Putin said, you know what? We're not selling our oil and gas anymore for US dollars. We're only doing gold and rubles. Okay. Okay. So there's two pipelines that go into the Baltic Sea from Russia all the way to Germany. Okay. They're very, very long. They go into the Baltic Sea. They go all the way over. Well, last summer, a few months ago, someone with deep water submarines blew up those pipelines. Not in one place. They blew them up in one place. It was called Nord Stream 1 and Nord Stream 2. They blew them up and they went up like 50 miles up the way and blew them up again.
Wow.
Two submarines. Now, no one knows who did it, but I'm just saying, once Putin said, hey, you know what? I'm not, And another thing happened. The president of the United States, once Putin, when the president of Russia went into Ukraine, the president of Russia was like, really bad. And our president said, we want Russia out of Ukraine, blah, blah, blah. And that was the rhetoric for a month. As soon as President Putin said, we're no longer selling, our stuff for US dollars, we're going to take gold. Then our president said this, we need a regime change in Russia. Whoa, that's way different than saying we need you to remove yourself from Ukraine. Now, if you take that in context with Muammar Gaddafi and Saddam Hussein, kind of makes like a little bit of sense there, right? Okay, so let me get to the conspiracy part. Okay, so how does it have to do in Bitcoin? Okay, the year is 2018, and it's December. And the Federal Reserve says, you know what? The economy's doing so well. We have low unemployment, GDP. We're going to raise interest rates 3 times next year in 2019. Now, Chase, listen, less than 45 days later, the Federal Reserve, who has all the data in the planet, they have more data than anybody. 45 days later, they said, sorry, we made a mistake. We're not going to raise interest rates 3 times in 2019. We're going to lower interest rates 3 times till 2019. I have an economics degree, and I'm like, man, something big just happened. I don't know what happened, but something huge just happened, right? So I had my antennas up. So then March, 2 months later, I read this report. In Europe, there is $3 trillion of negative interest rate bonds. I'm like, I have an economics degree. I've never read a book, a paragraph, a chapter, a sentence on a negative interest rate. I don't even know what a negative interest rate is.
Right.
This is what it is. If you buy this bond from Germany, okay, a sovereign bond, you are mathematically guaranteed to lose money. That's a negative. And I'm like,
that's crazy.
Why would that even exist?
Right.
Doesn't even make sense. Okay, so that's March of 2019. July of 2019, I read another report. It's not 3 trillion anymore. It's 14 trillion of sovereign bonds in the Eastern Bloc country and Eastern Europe trading at negative interest rates. Why? And so I'm looking back at what the Fed did. The Fed basically said, well, if anyone's going to borrow money around the world, rather than borrow the German Bund from the German Bund, right, at zero or zero or negative, why don't you just borrow the US because we're world reserve at almost zero? So they lowered their interest rates down to zero for a long time. Why? They're protecting their number one product, right?
Right.
If you're going to borrow for 30 years, you better borrow US and then pay us back in dollars for 30 years. It was a move to protect that's how I view it, right? That's my theory. And so that's kind of got things going. Okay, so then here's the conspiracy. So I got to get the dates right here. The summer of 2020, the SEC sues, okay? The SEC sues JP Morgan, place where you used to work, right?
Right.
Okay. And they lose. JP Morgan loses a lawsuit. What were they being sued for? They were being sued for manipulating the precious metals market for 9 years. JP Morgan. Their fine, $930 million fine, almost $1 billion fine for manipulating this market for. Now, no one, the important part, no one went to jail. That's weird, right? But anyway, pay $1 billion and we'll let you go free. They probably made $10 billion, right?
Sure.
So I'm like, wait a minute. So a company with limited amounts of money can control the gold and silver market for 9 years? How is that? So it's possible. Yeah. Okay. It's possible. Okay. So then I believe the SEC shared this information of how they controlled the market with the Federal Reserve. And the Federal Reserve is at the point going, wait a minute, Bitcoin could be a competitor. So go to the summer of 2021, 1 year later. I believe by that 1 year, they had put together, the Federal Reserve and the Treasury and whatever, had put together a plan to control Bitcoin. Bitcoin was about $30,000 at the time. From July to November, it went from 30 to 69,000, like straight up.
Right.
The reason to control a market, I believe from my old trading days and all my studies and back in the day, you need at least 45 days of trading volume to control a market. So if Bitcoin trades 100 coins a day, you need 4,500 Bitcoins. If Coca-Cola trades 100 shares a day, you need 4,500 shares, right? Or if they 1,000, you need 45,000, whatever it is. If you have at least 45 days of trading volume, you can control it. So this is what happens. So I believe it took them a year to set it up. So the summer of 2021, and by November 2021, it hit an all-time high. So this is theory. I realize what I'm doing is theory here, but if I had 45 days of trading, or let's say I had 60 days of trading volume, and I took all that and I put it right at 69, I put a limit order, sell all this at $69,000. And buyers keep coming in, buy, 69,000. And then me and you, Chase, we go, wait a minute, there's a big seller at $69,000. Crap, we better sell too. So we start selling and it goes down to 68,000. And guess who starts buying at 68,000? The Federal Reserve. They're replenishing their 45-day trading volume. And then we say, Chase, there's someone buying at 68,000. So we start buying. And they let it go back, and we start buy. They let it go back up to 68,700. They won't let it hit a new high because that would be a bullish chart. And then they put their 45-day trading volume at 68,800. And buy. You can't get through it. Mm-hmm. And then we start selling, goes down to 66,000. Guess who's buying? The Federal Reserve is buying at $66,000 to replenish their 45-day supply. The point is here, they're not trying to make money. That's what hurts your head. You're competing against a company, the Federal Reserve, who's not trying to make money. They actually make money. They have, you know what I'm saying?
Right.
Me and you make money differently than they make money. They actually make it, right? Yeah. They're not trying. Usually when you're playing in a financial game, you believe you can win because your opponent has the same motivation. They're just trying to control it. They're not trying to kill Bitcoin. They're just trying to control it like JP Morgan controlled the silver market for all those years. Mm. But you have to have a lot of it. And that's why it went from 31,000, someone was accumulating it. And so that's what I believe happened. And the reason, there's a couple more things. In November 2021, 4 basic things happened that gave me the clue to put this book together. Bitcoin hits its all-time high. Okay. And I believe the 45-day trading volume happened. Hillary Clinton came out, and I love people that love to get to the microphone. They love to just spew things. And she said in November 2021, Bitcoin has the potential, something I can't quote her, but Bitcoin has the potential of taking down the US dollar as the world reserve currency. She said that over the microphone. Now, is she just telling her memes? Let me give you the probabilities. So the book is based on this. In my lifetime, I stopped doing predictions because I don't believe anyone can predict things. I started running my life on probabilities. What's the probability of this? What's the probability of this? Not predicting the future. And then basing decisions on probabilities. So what's the probability that Hillary Clinton just spewed that out off the cuff? Hey, Bitcoin could take down the US dollar. Or was she privy to some meetings earlier that month, top secret meetings that told her that this was going to happen? The Federal Reserve had put together a plan to control Bitcoin, and this is going to happen. And she was just telling her memes out there, hey, listen to me. I always have the inside scoop. I would say the probability on that is higher than she just spewed that out. Another thing that happened in November, the SEC approved an ETF for Bitcoin, not for the spot price, for futures market. And guess how JP Morgan used the gold and silver market futures contracts to spoof orders all day long, controlling the price. They needed a futures, not a spot price. They needed a future. So a lot of times in life, you learn something when what people don't do. Not what they do, but what they don't do, and they should do. Wait a minute. You should have approved a Bitcoin futures market ETF and at the same time a Bitcoin spot price, but you didn't. You denied the spot price, and you've kept denying it and it just happened just a little while ago this last summer. They denied it for almost 2 years, 3 years. You can't have an ETF with spot. What? But you can have an ETF with futures? Yes. Why? Because someone's trying to manipulate it. They're hypothecating. They can sell more Bitcoins than actually exist, like they can do gold and silver. You can sell more contracts on silver than silver actually exists. Mm-hmm. All right. And there was a fourth thing that happened let me see my notes here. The XRP lawsuit, SEC, was extended that month forever. And XRP was a coin designed to compete against the SWIFT system, bank-to-bank wire transfers, which is a dollar-based system. So all those things happened in 1 month, all of them. And then the Bitcoin started dropping in price, okay? Now, again, they're not trying to kill it. If they kill Bitcoin, then Ethereum just take their spot. Mm-hmm. But if they keep Bitcoin alive, then they know how to control it, right? And I believe what happened this last 6 months, with the 11 ETFs coming out. So think about what just happened here with Blackstone. So Blackstone gets approved to have an ETF spot price for Bitcoin. Also, 10 other companies at the same time were approved. So you have 11 companies that can do Bitcoin spot price ETF. Now, I didn't read them all, but I barely skimmed through this, but this is BlackRock's application, which the SEC got on the news and said, we're about to approve, but we needed BlackRock to change their application in a few ways. We had to negotiate. That's why we've taken so much time to approve this ETF, like 3 years, right? BlackRock's application says, and I'm paraphrasing, it basically says that BlackRock can sell more contracts of their ETF that actually exists. They can hypothecate it. They can write paper on it. Why would you allow a spot price ETF to write? Wait, it's back to the futures market, right? Same things happen with silver. You write more contracts on silver than silver exists. You can control the price. That's the first thing. The second thing in the BlackRock application it said was, which is strange. I don't know why this would be written in there, but it basically says this. And BlackRock writes this: if Bitcoin, I'm paraphrasing, if Bitcoin ever forked, BlackRock ETF doesn't really know which fork we would choose. Why is that written into the application for an ETF spot price? I don't know. Except if my theory is true, then they're protecting and promoting the US dollar. It's a competitor. Okay, so let's get back to world politics for a minute, just for my conspiracy to keep going. All right, so when you hear something strange in the world, you go, that doesn't make any sense. Joe Biden gets elected and he turns off the Keystone Pipeline from Canada. Why? Why would you do that? Well, if you're a customer of Saudi Arabia, you can kind of tell Saudi Arabia that you got to be in US dollars for oil. But if you buy no oil from Saudi Arabia, it's kind of hard to tell them what to do, right? And so that was one thing. Now think about the last summer. Let me get another one. Last summer, you heard this story. China brokered a peace deal between Iran and Saudi Arabia. I'm like scratching my head. Why would China want to do a peace deal between Iran and Saudi Arabia? If you put the dollar in, it makes sense. Okay, you go to Iran, you say, Iran, listen, we've been trying to buy oil from Saudi Arabia in the yuan for years and years and years, and they won't sell it to us. Why? Because they need protection from the United States government. Military, they need the Navy. So Iran, who do you hate more? Do you hate Saudi Arabia or do you hate the United States? Well, we hate the United States way more. Well, you're strengthening every day. You're strengthening. Why? Because you keep attacking Saudi Arabia and Saudi Arabia. But one day, listen, if we sign a peace treaty between the two countries, in a few years, Saudi Arabia go, wait a minute, we have no threat now from Iran anymore. We don't really need the Navy, the aircraft carrier off our coast. We don't really need, the F-35s on our bases, right? Therefore, they might start selling oil to China, which is a huge customer, in yuan, which weakens the US dollar, which weakens the US. Iran, do you get it? Yes, we do. Sign it.
Yep.
So this is all theory. This is all my theory. But not every time, but almost every time I put the US dollar into crazy stories, it makes sense because people like to play games. They play these video games. This game I'm telling you about, dollars, gold, and Bitcoin, the US dollar, it is the biggest game ever that's ever been invented, ever in the world history. The geopolitics behind this. So people say, well, wait a minute, John, China's going to take over Taiwan. Don't think so anytime soon. China is a net importer of oil. China is a net importer of food. And that's why China right now is building pipelines to Russia as fast as they can, because most of their oil comes over the water through the Indian Ocean. Well, a couple of aircraft carriers could cut off that oil, right? So China attacks Taiwan. The U.S. could cut off their oil, pretty much all of it, in 120, 180 days, right? It could just chop it off. And China knows this. They have an Achilles heel. They know this. And so that's why they're building their, pipelines as fast as possible to Russia, because they have an Achilles heel. The United States is a net exporter of energy, and the United States is a net exporter of food. So we have a huge advantage over a lot of countries out there, right? But it's down to, the US dollar. So my book, Dollars, Gold, and Bitcoin, tries to, explain this world economic game that's called the US dollar, why the US dollar is probably a Ponzi scheme, why it's an impossible to taper because it's huge, right? And I have people, when I speak on stage, I have questions afterwards, and they argue with me a little bit about the US dollar and the US pushing their agenda all over the world. And I would say, and this is my comeback, and I always say, listen, we can have a great debate. You would argue the US dollar and the United States and all their military with all the bad stuff they've done around the world. And I will argue that since 1944, because the world has a world stable currency that loses value, no doubt, and because we have a U.S. Navy that a little country can sell their trinkets around the world with having a Navy, more people in the history of the world have been brought out of poverty and aren't starving today because of the U.S. dollar and the U.S. Navy. And you would argue they've done a lot of bad stuff. And I would say compared to what? So you're saying we should go back to 1944 and not do the Bretton Woods Agreement, not have the Navy, not have the US dollar. And you're saying, and I believe your argument would have more people today starving, their bellies would be hungry around the world. And I say less people today are starving. And no country has benefited more than China. China has benefited more from the US dollar stability, even though they don't like it now.
Yeah.
And the U.S. Navy around the world keeping things flowing than China. So, China's got some big problems right now. They got huge problems in their economy. And, but the U.S. dollar has helped them this whole time until now when they're big. Now they don't want the U.S. dollar anymore because they want to print their own money and buy oil. So that's kind of the premise of the book.
Yeah. I mean, it's so interesting when you pull back the curtain a little bit and see all the dynamics and the geopolitics and all of it is super fascinating and something I haven't really thought about, but I mean, as you explain, it makes a lot of sense. And conspiracy theory or not, right? Yep. There's motives behind everything, and so really interesting. That's great. Well, yeah. If anyone's listening, for those who are listening, where can they pick this up?
Amazon.com
Okay.
Or Audible.com.
Okay.
It's on Audible. It's my voice. I went in.
You read it? Okay.
I read the whole
great.
book. It's my voice, the whole book. Yeah.
Yeah.
Yeah. And I go into a one chapter about the U.S. digital dollar. They're slowing down the Bitcoin, exception of Bitcoin, until they can launch their own U.S. digital dollar. And I believe that's inevitable. I don't know when it's coming, but I believe it's inevitable. But it could be May 2033, the 100-year anniversary from the gold confiscation in 1933, where they say, for the good of the country and to keep the U.S. dollar on top, everyone needs to stop using gold, silver, or Bitcoin. That's outlawed. And you only can use the U.S. digital dollar. I go and have a chapter on that explains the probability of that happening, which is high. It's very high that the U.S. digital dollar is coming, but I don't know exactly when. 2033 is just an example because it's a 100-year anniversary. It might be sooner, it might be later. I don't really know, but I do believe it's coming. I believe you can't even stop it. I think it's just coming. I tell my kids, listen, when I was a younger man, I give them this visual. Okay, I'm standing knee deep in the ocean, and there's waves coming in. And I have my arms stretched out trying to stop waves from coming in. That's me as a younger man. It's stupid. Me as an older man, I just get a boogie board and ride the wave, right?
Yeah.
I'm not trying to stop waves anymore. I'm just like, how far can I ride this wave, right? And so once this is, and then what I'm talking about in my book is the basis of building probabilities. If you get the game of the US dollar around the world, and the number one job is to protect and promote it, if you get that game, you understand it down to the core, your probabilities that you make, your assumptions on probabilities, I believe I will be able to increase your probabilities more in your business life and your decision making by reading my book or listening to my book on audible.com. So that's kind of the pitch.
Yeah, it's got application throughout. Yeah, I love it. Well, John, just wrapping up here, I something that I like to end my podcast with most of my guests is just talk about how you define success in your life.
Okay.
It's holistically, I guess, work or family or what have you. But yeah, how do you kind of define success?
It's kind of the same for family, work, business, everything. It's where I believe successful families, successful businesses, successful people are able to transfer knowledge from them to their partners, to their family. And if the person in the family dies or can't, the family members know how to operate everything. And as a team, they're way better as a whole team. But losing one family member, losing one business partner, everyone is transferred. As opposed to, let's just crazy that one guy or one lady in a company keeps all the knowledge to themselves because they're afraid for their job and they don't want to transfer that knowledge. That's not success to me, because you haven't gotten to a point where you're confident enough in your own abilities, you're confident enough in your team, you're confident enough in your team that really is synergized. So success to me is a form of that in a family. So think about this. You got this grandpa, let's say he had 10 kids and they had they get 100 and something descendants, and they're all still together. Now, of course, you're going to have some people, maybe one grandkid was thrown in jail for a few days, or someone does drugs or whatever. But if you have this grandpa at the top and they've got this 90% of his descendants are all contributors to society, all good, honest, working people, and they, good people, and they all gel together, you can't buy that. It takes decades and decades to build that success. And a company's the same way. Running a company, to be at the top, or a group of people at the top, and they have their employees and their associates being able to duplicate what they do. And if they get killed in a bus accident, next day, everything still works right. That's success, because the person at the top, or the people at the top, are not afraid for they're so successful. The definition of success that they are not, threatened by people under them that are smarter than and better than. Now, that's kind of how I define success.
Yeah, love it. Leaving a legacy, business, family, and having that go throughout time.
It's a transfer of knowledge. Yeah. And you're not afraid to transfer the knowledge.
Yeah.
But you'll see this a lot of people, and the reason they do weird things is because they don't want to give up power, and transferring that knowledge gives up power. And therefore, deep down, I don't believe they're successful to the full. They're successful in this area or this area. But when my definition of full success is that coming to the spot where giving information and making sure people understand is not a threat to your success.
Yeah. Well, thank you for sharing all the information you shared today.
Glad to be here.
On your background, your book, all of it. So great, John. Thank you again for making the time.
Thank you. Have a great day.